You are now listening to E4 Bizlosophy, the podcast that guides you on creating abundant wealth and leaving impactful legacies by putting your business in a winning position. Welcome to the journey. I'm your host, Tira D, with my special co-host, Dr. Curtis C. Cochran, aka Doc C. Thank you for joining us. Good afternoon, Dr. Cochran. How are you today?
I'm doing great. How are you doing?
I'm doing great, actually, myself as well. Thank you for asking. Yeah, so last episode, we talked about using your business tax or your business as a tax shelter. And today we're going to go into the how and what of that by looking further at tax deductions and entering business ownership. So my first question I want to ask is, how do business tax deductions work?
Well, and you and I will definitely go into the greater details of all the types of deductions and how they all fit into a small business. But the answer to your question is that any direct or even indirect expense that is going through your business is a tax deductible item. And what a lot of businesses do is, especially small businesses, what they do is they basically run a lot of their even personal expenses through the business. Now, a lot of people go, wait a minute. You mean I can write off certain personal items, or if not all my personal items, through the tax through the business and get deductible with it? But that's not necessarily true, because it all depends on what it is that you're actually trying to run through that business, and is it a item that certainly affects the buy and sell of products or services or whatever you're doing within this business. So you have to be careful on that. And then the other thing that we do is that when we come to evaluate, or at least give the business owner a value of their company, we have to actually go in and recast these dollars, because ultimately what business owners try to do with the IRS is to show the IRS that you're making as little as possible. However, when it comes to understanding the value of the business, you want to find out really what the true net worth of the company is. And that's why we have to bring back and recast those dollars to actually determine the true value of the business.
Okay.
If that makes sense.
Yeah, absolutely. It makes sense. And I kind of wanted to go into the whole recasting and how that's done. But I guess we'll save that for another episode. Or maybe we can.
Yeah, I can shed a little bit of light on that. I mean,
that would be great.
What that really means is, let's say, and I'm just going to use a simple dollar amount. Let's say that your revenue, you made $100,000, and so your sales, you made 100,000. Okay, so if you didn't have any expenses against the revenue, then the IRS would simply say, okay, Tiara, you made 100 grand. That's your net. We're going to tax you on that 100 grand, which they're going to take a significant piece from that.
Right.
But what we do in business is we say, well, wait a minute. Okay, so we have our cell phone bill, we have our internet bill, we have our car expense, because we have to write off traveling expenses to and through, to our clients, if that's the case, or you just have all these line items against that 100,000. Okay. Now, I did mention the car. Let's say that you have a personal car, but you use it for business. So you write off, you write off your gas, your oil, all of those things, your fuel, the fuel, and even if you lease the vehicle, which of course that's what I would recommend that you do, is you lease the vehicle.
Yeah.
And we'll talk about all those things in our next podcast. But the bottom line, that 100 grand came all the way down to 30 grand. Let's say that now you've written off 70,000 cost of goods and all of these things, and you now have a net of $30,000. So now the IRS, instead of being taxed at 100,000, you're taxed at 30,000. So significantly less than what you would have been, and that's why we call that a tax shelter. All small businesses, everybody should open up their own business, and you'll see a lot. As we talked in earlier podcasts, we have seen that. We have seen that because of the pandemic. So now, when it comes to recasting, so now we take those line items that you have shown Uncle Sam, that whether they are a direct or indirect expense, but you've shown the IRS that you're actually using personal items as a business item as well, because it can be done. And so what we do is we take that value and say, okay, well, if you didn't run those dollars through the business, what would it actually be worth? So instead of 30,000, maybe it's 60,000. So now you really only had 40,000 of write-offs, cost of goods, or other expenses. Now the true value of the business is 60,000 versus 30,000. And that's kind of what recasting, really figuring out where those dollars, how they add value to your business or not.
Right. Sounds like a little bit of a complicated process that I would love to just leave to the professionals like yourself. But it does sound kind of, complicated to me, but I'm sure for you, it's, a lot easier.
Well, yeah, I didn't learn this in a day, that's for sure. I mean, I've made plenty of mistakes along the way, but mistakes that you learn from, and you just keep going. But the IRS people, I always want to tell the listeners that don't be afraid of the IRS.
Exactly.
The only time that you actually are afraid of the IRS or even the law is if you are doing something illegal, and then you want to be afraid of it. But as I've said before in the other podcasts, is that our Constitution, our right as taxpayers, is to pay as little as possible, and that's your right. That's everybody's right. And so you have to be aggressive and not be afraid. And really, to be honest with you, I can't necessarily speak for the IRS, but they know that the majority of people are afraid of the IRS, afraid of taxman. So, and they don't mean to be like that, but it's just the way it is, because you hear of all the stories that go on, and most of them are just stories.
Yeah, I was going to say that you just, hear about the stories, and you just build up this fear, in your mind about it. And also it's a matter of not educating yourself about, things. When you go into business, I think it's important, that you educate yourself as much as you can, on in all aspects, but especially in your finances.
Absolutely. I totally agree with that. Whether you're going to invest in stocks or bonds or mutual funds or any of those kinds of things, a lot of people will turn to a professional, which there's nothing wrong with that. Turn into a professional and ask for their recommendation or even leadership. And I tend to say that, you study these things yourself. That way you can ask the appropriate questions to the professionals. And it could be whatever. It could be accounting, it could be your attorney, it could be your stockbroker, it could be all of those things. study these things yourself so that you are not blinded by something that comes blindsided is the words I was looking for, that comes around the corner, you see. So that's what, definitely study yourself. Yeah.
Yeah, absolutely agree with that. And I learned that very early on, with my parents, they taught us those types of things as well. So what types of expenses can a business owner write off? Like, how do you determine what you can deduct as an expense?
Yeah, it's kind of like I said earlier. You have to look at what is it that you do in your business, and that's my dog. I apologize, viewers. He gets all excited, but it's if it's a direct, or like I said, direct or indirect. But if you do anything, for example, let's say that you are an insurance broker, you sell insurance.
Mhm.
That means, and if you're a good one, that means that you are everything that you do. You're talking insurance. You're talking it to your friends, your family, every lunch. Oh, by the way, Tiara, do you have insurance? You say those words, it's a write-off.
Yeah,
You are doing business.
business. Yeah.
So it's kind of like I said again earlier. I recommend people that if they have an 8 to 5 job, is look at these MLM companies, multi-level marketing companies,
Mhm.
because let's say Mary Kay Cosmetics. I get into Mary Kay, and I'm going to sell cosmetics. So everything I do, I say, hey, Tara, do you need some makeup? Do you need? It's a write-off.
Right.
And if you do that every 24/7, people don't realize that you're doing two things. You are actually making money, future money, but you're actually making money based on that tax shelter that we talked about. So that's why you start that business, and it's in that business you want to make sure that you're passionate about, like we said before, because it's going to be a lifestyle. It's definitely going to be a lifestyle change.
Right. Absolutely. So another question I have is, and I just read about this recently. Well, I probably already knew about it, but anyway, what is a 100% tax deduction? Is there such a thing?
100%.
Right.
Well, that's
Like something
that's a
that's 100% tax deductible.
Oh, well, gosh. Now the question kind of what business are we looking at?
Right.
Give me a business, and then I could go from there. What business are you looking for?
Yeah, I'm
Let's say
no
what we talking
specific
about. What
business,
business do you have?
but
Right,
no, there
right,
was,
right.
yeah, I didn't have a specific business, per se, but
Right.
I was just reading somewhere that, there are some things that you can 100% take a tax deduction on. But I guess it's like you said, it really kind of depends on the business, the specific type of business.
Well, yeah, I mean, there's obviously, your rent. Let's say you own a business, and let's say you own a restaurant, and
Right.
your restaurant, you have a lease. You pay $1,000. You lease a unit for $1,000 a month. Well, that's 100%. You are leasing a business. I mean, that's 100. You're doing business in this building at $1,000 a month. You can write every penny off of that. That's 100%. And then, of course, anything tied in there, your phone, your internet, and all of these things that run this business, 100%. There's no doubt about that. What and so I guess a good answer to that would be anything that is directly related to your business, 100%.
Right.
Anything that's not direct, which again, let's say for example, your vehicle. So your vehicle, you use it for personal use and tax use. So tax use meaning business use. But what you're trying to do, let's say you have you had 20,000 miles on your car this year. So the IRS is going to ask you, okay, you had 20,000. How many of those miles are for business and how many for pleasure? Well,
Right.
personal. And so then you break it down. Okay, at 20,000 miles, I use 13,000 for business, 7 for pleasure. You get to write off the 13,000. So that's an example of a partial, partial expense that you can write off through the business, and that's what you want to do. And the other thing that you definitely want to do is if you start your business today, is you again contact your CPA. If you don't have a CPA, you get one, and you want to make sure that the CPA is business savvy. A lot of them are smart, very intelligent. They're number crunchers, but as far as business savvy, they're what I say is what I mean by business savvy is aggressive in relationship to the tax code.
Right.
Do they understand? Do they really understand the small business player? Because the small business player is basically going to write off everything that they own through the business, and you want to be aggressive by that, and of course legal. That's what we're after, but that's the whole idea on that.
Right. Yeah, I absolutely agree. Anytime we're talking about a professional, yes, I'm totally all for it. So yeah, I completely agree with you on that. Now, are there any maybe major things or information that you can share with us today in regards to business tax deductions?
Well, again, the very first thing that I would do is, and I've said this many times, I even did a seminar on entering. The very first thing that you really want to do when you enter a business is it are you going to start this business all by yourself?
Right.
Meaning it's right out of your garage and you're going to start up. So now you don't have a marketing plan. You don't have all the business plan. Of course, you're going to have to do those things. But in the meantime, as you are generating these documents, you're going to make changes within the first 6 months, guaranteed, because you really don't know the direction that your company's going to go. Now, if you bought a franchise, then you have a business model, and for that business model and a marketing plan, they're actually good, but it's really costly because you have to pay monthly commissions on certain things, whether or not it's before or after revenue. And I don't want to go into detail on that, but the point is that if you have a franchise, they kind of assist you a little bit when it comes to the tax issue. But if you don't, then what you want to do, like I said before, is contact the CPA, tell them you're going to open up a business, what are the certain write-offs, and again, if they're aggressive, they're going to tell you write off everything. And then we'll worry about it during tax season. And of course, that's what they'll do. Then you have a conservative one say, oh, okay, you can write off mileage at 52 cents per mile. And, they'll say all of these specific things that you want to be careful on. What I would recommend to our viewers is our next podcast, we're going to go into great detail of the write-offs, why you want to do it, why Uncle Sam says, okay, I agree with it. And we'll be able to answer a lot of these questions specifically in that next podcast, because we're going to go into line items and, of course, what Uncle Sam's looking for, not looking for, what you can prove, what you can disprove, that kind of thing.
Right. Okay. Yeah, that's great. I look forward to that episode. So I read in an article that entrepreneurs, I'm always reading articles. I just
That's good.
that
That's
yeah. I read that entrepreneurs often make their biggest tax mistakes before they're even up and running. And they do that by overcomplicating their initial setup. And an example of that would be maybe they're too focused on the structure and the location, or they don't keep proper financial records. Um, do you have any advice as far as that is concerned?
the biggest problem that I see is they're so busy. Small businesses are so busy trying to keep the doors open, which is
Mhm.
yes, it's tough.
Right.
Um, that uh, they do not have good financial records. And
Mhm.
and I'll tell you, it is imperative that they do. And we will share on our next podcast. I'll share an easy website. This website it's a piece of cake to use, and it's to consolidate all your tax information daily. It takes 5, 10, 15 minutes, and you have it. It's web based, so even if your computer crashed, you would still have it. It's on the web. You can get it anywhere. So that's essential. But the answer to your question is the number one mistake that they make is that they do not from the beginning keep proper records.
Right.
and
Mhm.
and you have to.
Right.
you I'll give you an example. I went into a company, a small business company 2 years ago, and
Mhm.
I said, okay, well, we're going to have to do an evaluation. I have to find out how much your company's worth so that we can actually list it and put it on the web. And in order us to do that, I need to find your past 3 to 5 years tax returns and all of these things. And they came out with, believe it or not, and this is, I'm not kidding you, this was 2 years ago, not 20 years ago. This was 2 years ago that they came out with a shoebox full of receipts.
Wow.
And, and, and I go, well, what do you want me to do with this? Well, this is our business in this, in the shoeboxes. This is this is this is 2018. Actually, this was 2018, 2019, and 2020. So you had three boxes
Wow.
of receipts. And I said, okay, well, what am I supposed to do with this? And he said, well, then you can generate that information. In other words, what he was asking me to do would be what a bookkeeper or an
Right.
accountant would do to
Mhm.
generate the tax stuff. And I said, no, I'm not going to do that. But see, that they were in business. They have been in business for 10 years. And so they didn't have a proper accounting system. They didn't have
Wow.
good financial records. And really, ultimately, what that does is that when they go to try to sell it or even try to get capital from banks or lending institutions,
Yeah.
that they're going to show them a book, a box.
Right.
It just doesn't work. And so what you want to try to do from day one is
Mhm.
to take and do proper financial bookkeeping and record
Right.
keeping. Definitely.
Mhm. Yeah,
Number one.
absolutely.
That's number one.
Yeah.
All the other stuff you don't have. Well, you obviously have to try to keep the doors open. I get that, but
Yeah.
you really have to do that for sure.
Yeah, yeah, absolutely. And I mean, I can imagine maybe at the start, 10 years ago, it was a little bit different. But as time progresses, it's important to, maybe keep up with the technology and for your record keeping and everything like that. Um, and putting systems in place. And I would recommend personally at when you're starting your business, it's important to just kind of lay all of that stuff out, as far as how you're going to keep your records. Is it going to be in a shoebox, or,
Yeah.
are you going to look into a couple of different programs, talk to people, do some research, put all that stuff in place, before you even open your doors.
You're absolutely correct. And one of the things that you'll discover is that, maybe QuickBooks, maybe you'll go QuickBooks, and then you discover that, well, QuickBooks it's too complicated for
Right.
my business. So you simplify things. And I'll tell you this, why not simplify your whole life by doing that? Simplify it so that a third grader can understand.
Right.
If you can do that, then not only will you understand it, but your consultant, I will be able to understand it. Also, your lending institutions, if you're trying to get some dollars, and of course Uncle Sam, and eventually a buyer will walk in and say, okay, I see where all your dollars are going. Okay, I see the cash flow, and I see now how you came up with the fact that your business is worth $1.2 million. Okay, I will pay you 1.2 million. See, that's the whole purpose. The whole purpose of running a business or starting a business is to eventually exit the business.
Right.
You're not going to do it. You're not going to do this dang thing forever. It just doesn't work that way, and we know that. So why not? And this would be the second thing that I would do. Actually, it's kind of close to the first, but if you are going to start your business today, then I would have an exit strategy in 5 years.
Yeah.
No more than 5 years, but 5 years. And there's a reason for the five, that based on what we talked about before. If you're, the IRS, if you are in business for the 70% of the businesses are still open, their doors are open for the first 3 years. It's year 4 and 5 that you see a lot of them drop off, and they end up going, belly up. And that's why you hear the statistics that, if you start your business within 5 years, only 5% or 10% are successful. That's because year 4 and 5, year 3 is really a turning point. And that's why IRS says, okay, we're gonna allow you to take a loss for 3 years. We'll actually allow 3 to 5 years, and for some companies even more, as you've read about in the paper and so forth. But ultimately, that 3-year period is the big one, and that's why you want an exit strategy for 5 years, because you're going to do one of two things: either you'll exit with a loss, it'll go belly up, or you will actually grow the company, which is a great book. It's called No Man Left Behind or something like that. Anyway, it's a great book because you are going to eventually do one of two things: you either close your doors, or you're going to expand, or maybe even sell. But nevertheless, have that exit strategy for 5 years.
Right. Well, once again, some very excellent advice that you're giving here, and I thank you, for sharing as always, because I always learn so much, each episode when talking with you.
My pleasure. I love it. I mean, I as I just love to see people open up their own business and see
Same.
what I see, because they have so much potential to not necessarily just do the 8 to 5, but
Right.
if you want more, you have to do more. If you want more, you're going to have to give more. And this is why people open up their own businesses, because you have a little bit more control over your own finances and your own future, and that's what it's all about, really.
Right, absolutely. Well, thank you to the audience for joining us also. Don't forget to like and subscribe if you've enjoyed the show. Follow us on our various social media networks at E4BizPod. And then tune in next week for another episode of E4 Bizlosophy Podcast. Thank you, Dr. Cochran.
Thank you so much. You have a great weekend. Appreciate it.
All right, you as well. You have been listening to the E4 Bizlosophy podcast with Doc C and Tira D. We would like to thank our audience for taking the time out of their busy schedules to listen to our podcast. We hope you will continue to tune in week after week. Please don't forget to follow us on at E4BizPod on the various social networks. And if you've enjoyed our podcast so far, please show us some love by leaving a like, subscribe, comment, or write us a review wherever you get your podcast. Join us again next Friday.